A market in a massive uptrend rarely sustains that momentum indefinitely. Eventually, the buying pressure hits a ceiling and the price action stalls. Major market trends never move in a straight line. To maintain an upward trajectory, a trend requires mandatory periods of consolidation. The market catches its breath before it can run again. Analysts map these specific structural pauses using a category of formations called continuation patterns. Identifying these temporary resting phases allows a trader to anticipate the resumption of the original trend, rather than panicking when a chart briefly goes sideways. Continuation patterns represent a distinctly different market environment than reversal patterns. Reversal patterns take significant time to build. They represent a slow exhaustion of the prevailing trend, signaling major market tops or bottoms. Continuation patterns are shorter in duration. They act as near-term or intermediate resting periods, indicating the prior trend is still healthy. The underlying tug-of-war between buyers and sellers reveals itself in explicit geometric shapes. The specific boundaries of a pattern show exactly how market participants are fighting for control. By mapping these boundaries alongside volume and time, analysts derive exact mathematical price targets. This geometric analysis transforms market activity into a highly structured, probabilistically predictable map. The first major geometric category is defined by converging boundary lines, known as triangles. This chart displays a symmetrical triangle, sometimes called a coil. To be valid, it requires exactly 4 reversal points, 2 peaks and 2 troughs, across 2 converging trend lines. Because this is a continuation pattern, it usually resolves by breaking out in the original trend's direction. This variation is the ascending triangle. A flat upper resistance line meets a rising lower support line, indicating that aggressive buyers are consistently stepping in at higher lows. This chart illustrates the exact inverse, the descending triangle. Here, a flat lower support line meets a declining upper resistance line as sellers overpower buyers. Regardless of the specific shape, triangles operate on a strict time limit for validity. A valid breakout must occur strictly within the final 2/3 to 3/4 of the pattern's horizontal distance. If the price drifts all the way to the intersecting apex point, the pattern loses its directional potency, and the resulting move is unreliable. Triangles act as compressed geometric springs with strict expiration dates, making time as critical as shape. Beyond standard triangles, there is a second category of extreme, short-term dynamic patterns. These specific formations require a prerequisite. They must follow a steep, nearly vertical price advance supported by heavy trading activity. Looking at this chart, that sharp initial upward surge is referred to as the flagpole. Immediately following that pole, we see the flag pattern itself, a distinct parallelogram that slopes directly against the prevailing trend. This chart shows a close relative to the flag, the pennant. Following its own flagpole, the pennant forms they are extremely brief, typically forming and resolving in only 1 to 3 weeks. Flags and pennants represent the market momentarily pausing during a hyper-aggressive trend, making them highly reliable, powerful continuation signals. A third category of patterns emerges when the boundary lines fail to converge, instead running parallel or actively diverging. This chart illustrates the rectangle formation, where the price trades sideways between parallel horizontal support and resistance lines to form a congestion area. Conversely, this chart shows the broadening formation, frequently referred to as a megaphone pattern, characterized by its diverging trend lines. The expanding boundaries of the megaphone reflect an extremely emotional, out-of-control market, where price swings grow violently wider. Because of that instability, this expanding pattern typically appears at major market tops and serves as a bearish signal. When boundary lines fail to converge or run parallel, it signals dangerous market instability, rather than a healthy pause. Geometric shape alone is not enough to confirm a pattern. We have to look at the hidden dimension beneath the price action, the volume validator. Relying strictly on trend lines leaves an analyst vulnerable to false signals if they are not confirmed by actual trading activity. As a universal rule, volume must demonstrably diminish as the price swings narrow. This drop-off in activity reflects a temporary equilibrium. Buyers and sellers have reached a state of indecision, waiting for a clear catalyst. The ultimate confirmation of the breakout requires volume to spike sharply as the price punches through the boundary line. Volume validates technical analysis. A breakout occurring without a significant surge in activity indicates a lack of conviction from the broader market. Once a valid pattern is identified and confirmed by volume, an analyst can shift from observing the direction to actively exploiting it. Continuation patterns possess inherent mathematical measuring implications based on their structural dimensions. This chart demonstrates the measuring technique for a symmetrical triangle. You start by determining the height of the vertical line at the pattern's base. You then project that specific vertical distance straight up from the breakout point at C to establish a minimum price target. Flags and pennants require a distinct measuring technique. These patterns are said to fly at half-mast. You measure the vertical distance of the preceding flagpole and duplicate that exact value upward from the breakout point. Geometric patterns provide literal quantitative yardsticks for calculating risk and reward. All of these individual projection techniques synthesize into one overarching master concept, the measured move. This theory dictates that a market swing following a consolidation will often perfectly duplicate the size and slope of the swing that preceded it. Under this framework, the intermediate correction wave, the continuation pattern itself, acts as the exact midpoint pivot for the entire macro trend. These measured moves organize daily price action into highly structured geometric phenomena. Pause for effect. Mastery of these geometric pauses produces a legible, probabilistic map of global supply and demand.